This visualization shows the top-line number of the U.S. national debt, $35 to $37 trillion, dwarfing any historical comparison. The government relies on foreign central banks to continually buy this debt, but that buyer pool is evaporating. Instead of buying U.S. treasuries, foreign nations are pivoting their reserves into physical gold. With fewer international buyers for its bonds, the government is forced to offer higher interest rates just to keep the system functioning. The math presents a closed door. The United States cannot afford to pay back a sum of this magnitude, but declaring a formal bankruptcy would trigger an immediate collapse of the global economy. The traditional escape routes are sealed off. The government is trapped in a financial corner, forcing officials to look for a radical alternative to the traditional bond market. At the recent Eastern Economic Forum, Russian officials presented what they claim is the specific blueprint for that alternative. Anton Kubikov, a high-level advisor to Vladimir Putin, asserted that the U.S. is secretly organizing a systemic, backdoor financial reset. The premise of this leaked strategy is to use a combination of cryptocurrency and gold to wipe out U.S. debt liabilities without ever triggering a formal legal default. If this intelligence is accurate, it describes a stealth operation designed to migrate the government's liabilities into a new digital environment, where the rules of valuation can be rewritten by decree. Step 1 of this alleged playbook involves creating a new legal framework, presented to the public as technological innovation. This process began when President Trump signed the Genius Act into law. This legislation targets stablecoins, digital assets engineered to track and maintain the exact value of the physical U.S. dollar. While presented as a move toward global competitiveness, financial critics warn that this regulatory push operates as a legislative Trojan horse. Because regulated stablecoins are backed by U.S. treasuries, mandating their use forces the massive cryptocurrency market to create a new, artificial demand for government debt. By formalizing stablecoins, the government is quietly constructing the financial plumbing needed to connect its unpayable debt directly into the digital crypto ecosystem. This flowchart illustrates the migration. The strategy involves moving that $35 trillion burden out of traditional bonds and into a digital crypto cloud. This action effectively ties the traditional dollar-based economy permanently to the blockchain. Beyond the financial risk, moving national debt onto a centralized digital ledger creates the infrastructure for total financial surveillance and the erosion of citizen privacy. Tokenizing the debt does not solve the underlying crisis. It merely moves the blast radius into a digital arena where the government has absolute control over the ledger. With the debt contained in this digital environment, the government can execute the central maneuver, unilaterally altering the code that determines the value of those tokens. Watch the math. By federal decree, a stablecoin originally pegged to equal $1 US is instantly reprogrammed to be worth 50 cents. In a single keystroke, half of the nation's $35 trillion debt burden is instantly vaporized. This method achieves a massive debt reduction without the international legal stigma of a formal default, which would otherwise lock the U.S. out of global markets. Grim. The reality of a stealth default is that the debt isn't erased by magic. The bill is paid by the public through the instant 50% devaluation of their digital wealth. Intentionally crashing the value of a currency destroys global faith. To survive the fallout, the system requires a tangible, hard asset backup plan to provide a new anchor for the dollar. This is the second prong of the Russian intelligence report, a gold revaluation designed to inflate the price of physical reserves and provide the collateral for a new system. This follows a very clear historical precedent. In the 1930s, the U.S. government confiscated privately held gold and revalued it from $20 an ounce to $35. That single decision destroyed 41% of the U.S. dollar's purchasing power, effectively transferring wealth from the public to the Treasury. In the 1970s, the government again changed the rules when trapped by debt, unilaterally abandoning its promise to convert dollars to gold. The proposed stablecoin framework adopts the same internal logic as these earlier interventions, using a change in valuation rules to neutralize government liabilities. Central banks around the world are reacting to these risks now, accelerating their physical gold purchases at an increased pace. This pattern of accumulation indicates that central banks are positioning their reserves for a systemic shift in how the dollar is valued. A digital to gold reset would now directly impact dollar-based retirement funds, fixed income accounts, and everyday savings accounts as the new valuation rules take effect. Protecting wealth in this environment requires holding assets that exist outside of a programmable ledger. Diversifying into physical bullion is a primary defense before the digital default is fully executed.